For more on where things head now, with just one more trading day left in the first quarter, Joe Terranova of Virtus Investment Partners is with us, CNBC contributor, and Victoria Fernandez, Crossmark's chief investment strategist. Victoria, I go to you first. We got talks of more rate hikes. We had a good quarter. Where do we go now?
Yeah, I think this is a very difficult journey that we're on here, Scott. We expect a lot of volatility for the rest of the year. And I think we still have a foggy windshield. We don't have a clear sign of where we're going. I think you look at what a lot of people are saying, looking at the market over the last few days, and you say, okay, some of the issues around the banking crisis have dissipated. We've talked a little bit about that already on the show today. You have the Fed's people assuming the Fed is going to make a pivot, and they already have cuts priced into the market. I don't necessarily agree with that, but that's what the market is saying. And you have a consumer, and here I think it's true, you have a consumer that is strong and supporting the economy. Liquidity has been a key word. And you look at consumer balance sheet liquidity versus their income is at 60-year highs, that ratio. So there's strength there. But I just think you have to be concerned. You have these Fed people talking about hiking rates some more. If the banking crisis is dissipating, then why would the Fed not go back to where they were a couple weeks ago, or maybe 75% of where they were a couple weeks ago, and say, wait a minute, we're back to higher for longer? That's going to flow through to earnings. That's going to hurt consumers in the labor market, and we're heading back to that recession talk. So maybe that's why we're getting the market pulling back a little bit today. I just think it's still foggy and it's uncertain exactly where we're headed, but I do think we'll get a mild recession regardless.
Doesn't seem, Joe, the Fed's going to go back to where it might have before the banking crisis happened, because then they would really be concerned about not only breaking something, but obliterating something.
Listen, we are a in-the-moment society, so we tend to forget where we were previously. We are still in the midst of the single most intense war against inflation in the last 40 years. And what comes to mind for me is that at the end of January, the S&P was 40.76. The S&P today is 40.50. A two-year Treasury was 4.1%. A two-year Treasury today is 4.1%. So why did the S&P fall below 3,800? Why did a two-year Treasury go to 5.08%? Because two numbers were so important, 517,000 and 311,000. And those were the job reports for January and February. And there was this overwhelming concern about an overheating economy and that a Federal Reserve was going to have to do more. Now what you're introducing is credit tightening. And credit tightening is actually an ally for the efforts of the Federal Reserve with their monetary fight against inflation. And I think the market has kind of lost a little bit of focus, and certainly in terms of positioning and sentiment. Once again, they're off sides for that, and that's why we're rallying.
But you said to me the other day, and it might have been off camera, the market shouldn't be here. Oh, you shouldn't be here.
If you were,
I think the implication you were making is, like, how are we up to the degree we are, and how is what's leading in this whole environment?
Complete from a positioning perspective, myself included, completely offsides all year. The commentary throughout this entire week from most people on the network has been fundamentally the market doesn't belong here. The market shouldn't be rallying. The market should be understanding we have credit tightening. We have a looming potential economic recession. We have the potential for the Federal Reserve to be doing more work. That all seems so logical, and it seems so easy, right? It seems so easy to say, sell the market here. That's why my intuition is saying to me the harder thing to do is to understand that there's something dynamically going on here in the market that's doing what? It's moderating the overwhelming bearish pessimism and overwhelming bearish positioning, and it's returning the S&P, Scott, not back towards the high from last year. It's just taking the S&P and it's putting back towards the top end of the range that it's been in since November, which is 3,800 to 4,200. That's all we're doing.